Good morning. Welcome to our webinar on Do you know what your company is really worth? What we're going to cover this morning in this fairly short webinar, the webinar will certainly be finished well within the hour, and that includes plenty of time for questions. What we're going to cover in the webinar this morning is a bit about us, why we're qualified to talk about company valuations, why we understand company valuations, and then the importance of valuations, the difficulty in doing valuations, which we'll cover, a bit about methodology, strategic premium, and then a bit about how we can help, and then we'll take questions. So please, as we go along, if you've got a question to ask, please use the Q&A button that's either the top or bottom of your screen, depending on how you're viewing this webinar. Ask a question, we'll pick up on all the questions at the end. So just to explain why we're qualified to talk about valuations and why we understand valuations, we're a specialist team of corporate finance advisors set up in 2000, so been going, we're in our 23rd year, and we advise full-time clients looking to sell their business or buy a business. We've done, when selling businesses, probably in about 60% of cases, we advise a client selling to a trade buyer and do the research to identify trade buyers and identify trade buyers worldwide. And about 40% of the time we advise clients on selling to management teams, and sometimes we act for those management teams in doing an acquisition, and occasionally we do corporate acquisitions for corporate clients. So our full-time work, we're all qualified accountants, qualified many years ago, been working together for a long time as a team, and we recognize the importance to clients, particularly when they're selling businesses. It's their lifetime's work, lifetime's value. They want to find the right pair of hands, a safe pair of hands, and get the best value for themselves, but they want to see the business continue, the employees continue to be employed, and the customers continue to be looked after. So it's really important to get these deals right. So we do a lot of early stage advice. In order to get the deal right, it's doing the homework at the start to identify what is possible. So we do a lot of work on providing valuations, doing feasibility reviews, trade sale feasibility reviews. We'll look at market activity, we'll provide a valuation, we'll do a commentary, we'll work with the client, talk about issues of value, issues of saleability, and ensure that our clients have clarity as to where the process will lead and what the likely outcome is going to be before they start the process. And that gives time. If the outcome isn't where the client wants it to be, it gives time to work on the business, improve the profitability, reduce the risk factors, improve the opportunities to get it to where they need it to be. So a lot of early stage work, but our main service is lead deal advisory. Once the client has decided to do a transaction, it's advising the client all the way through the transaction, whether that be a corporate disposal to a trade buyer or to a private equity firm, whether it's a management buyout or a corporate acquisition. So really our job is to work closely with the client, their other advisors, leading the deal and getting it across the line, not at any cost, getting the deal across the line if it's right for the client. Our website contains over 100 thumbnails of deals we've done. This slide hasn't been updated for a while. There's plenty more deals being done since this slide was put together. We're seeing a lot of deal activity at the moment, a lot of activity, a lot of buyer activity, getting good value for clients and completing deals on a regular basis. So in terms of finding an exit, if you're looking to find an exit, now is a good time for most businesses. The same images appear on our website and are clickable. So if something that stands out on that screenshot that you want to know more about, click on the thumbnail on our website. It'll tell you all about the deal. I'm going to hand over to Greg Barker now, who will take us through most of the seminar, and I'll come back in at the end just to talk about how we can help. And then at the end, Catherine's going to come back on and talk, host the question and answer session. So just a reminder, if you've got questions at any point, just use the Q&A button, ask the question, and we'll answer it at the end as best we can. Thank you.
Thanks for that introduction, Andrew. Good morning, everyone. So I'll just kick off this webinar by just talking about, first of all, why valuation is important to business owners. And for the vast majority of business owners, their company is their most valuable asset. And for that reason alone, having a clear understanding of what the business's value is and what's driving that valuation is important. Most business owners only really sort of start thinking seriously about what their company is worth when they're sort of leading up to a potential sale, when they're reaching a sort of retirement age. We would argue that it's incredibly important for business owners to have a clear understanding about their business valuation as they sort of develop their business many sort of years before they sort of look to sell. And that will help them make better decisions that will add value and make the company easier to sell when the time comes. Having a clear understanding of what a company valuation, how companies are valued, and what your business is worth can also help avoid very costly mistakes. And I've listed some of these that we come across on this slide. The first one, which is very common, is starting the process of seeking a sale of your business without having realistic price expectations at the outset. Commonly, there'll be sort of thousands of companies being marketed for sale at any one time. And only a small proportion of those will actually end up being bought and sold. Many will stay on the market for a long time or be withdrawn. And a very common reason for that is that business owners just don't have a realistic expectation of what sort of offers they will receive. And going down the sale process can be, at best, a waste of time, but also quite expensive. Having a clear understanding of valuation will also help in situations where offers are received out of the blue. It could be from an acquisitive corporate that is willing to make a very good offer, including a strategic premium, which I'll talk about later on in this webinar. So having a clear grasp of valuation is important in those situations. Many businesses will also set up employee incentive schemes, share option schemes, which will require a valuation to be undertaken for HMRC purposes. But it's also important that the right commercial value is set for those share options. We've come across situations in the past where a very high bar has been set for employees to benefit from share options that have been issued, which would be unlikely to be achieved, and therefore would end up demotivating employees rather than incentivizing them. And the other side of that is that sometimes share options are issued at too low a value. Perhaps they include too high a minority discount. And the shareholders can end up just giving away value unnecessarily, and a much a higher share option price would have been better. The other sort of potentially very costly situation that we've come across is where a minority shareholder might have been bought out at too high a value, which might have been paid for by the company taking on a high level of bank borrowings and diluting the equity value of the majority shareholders and making it much more difficult for them to sell and get full value for their shares when they come to exit. So many reasons why that valuation is important. Looking next at why valuations are difficult. The first reason is that there's a lack of comparable public data out there. In the vast majority of cases, when private businesses are bought and sold, the price is kept confidential, and even when the price is released, it's still difficult to kind of work backwards and work out what the multiple was for that particular transaction. So there's a lack of data out there. The second reason is that a company's accounts that are published at Companies House, first of all, a company's got to be a certain size in order to be required to publish its profit and loss accounts. So for many small businesses, the P&L data is missing. For larger businesses, even when a P&L is published at Companies House, the reported profitability can be very different from the underlying profitability upon which a valuation should be based. And I'll talk more about adjustments to profits for valuation purposes in a moment. Valuations are based on the underlying profits of a business and the expectations of future profits for that business. And therefore a real understanding of the business is required in order to come up with an accurate valuation. It's necessary to understand what the business does, which clients it serves, what the market's like, what growth prospects exist, and those sorts of factors you can't get just from looking at a set of accounts. So for that reason, it's a valuation that's just based on a set of accounts, just based on the numbers. It is unlikely to be reliable. It needs professional judgment to consider the business as a whole and non-financial factors in order to weigh up what the valuation should be. So various reasons why valuations are difficult. So an important thing to sort of be wary of is free valuations where that sort of professional time isn't taken to fully understand the business and understand what the underlying level of profits are. And secondly, where free valuations can also be problematic if the person giving the valuation has an ulterior motive. Perhaps they want to sign up a business to sell it, and there can be that sort of risk that a valuation might be overinflated to give an answer that the business owner wants to hear in order to place their business on the market. I think we might have skipped ahead a slide. Yes, so this is the right one. No. So yeah, there's various ways of valuing a business. The approach that we almost always use in our work is to arrive at a valuation based on a multiple of profits, and that's the methodology that I'm going to talk more about on the following slides. Other valuation methods that are often used are, for example, a multiple of recurring revenues, and this valuation method is commonly used for software businesses, particularly software as a service, and that's the reason why that sort of methodology is often used as opposed to a multiple of profits for those software businesses, is that there's an expectation that those businesses will be growing, be investing a lot of money into developing their software products and sales and marketing, and will become profitable in the future. But the current level of profits might not accurately reflect what the true valuation of the business should be. Other sort of types of businesses where you might have a rule of thumb like that would be professional services businesses, accountancy firms, where there's a standard sort of rule of thumb to value a business based on its annual fee revenue. Where you do have businesses that are valued based on a multiple of recurring revenue, say, it's also important to look at the level of profitability and make sure that use that as a sense check to make sure that the valuation based on revenues makes sense. Another method is to look at the balance sheet value, the net asset value, and this might be used in situations where a business is loss-making or distressed, and it's more appropriate to use a breakup value as to what the individual value of the assets would be if the business ceased trading and was wound up. And finally, discounted cash flow. This might be an appropriate method to use for early stage businesses where there isn't that track record of profitability that can be used to work out a profits-based valuation. A discounted cash flow involves preparing a forecast of future performance and then applying a discount factor to work out what the valuation of those future cash flows and profits will be. So yeah, that tends to be used for early stage businesses. We tend to work for mature and profitable businesses in our line of work. So I'll talk more about the multiple of profits method on the next slide. So as I mentioned, most mature and profitable businesses will be based on a multiple of profits basis. This is a very simple formula. It takes the underlying profits of a business and then multiplies it by a number which we refer to as the earnings multiple. I'll talk more about both of those sides of the calculation on the following slides. That basic calculation gives you what we call the debt and cash free value, or the enterprise value for a business. And this is the headline valuation that assumes that the company has no bank debts and just the working capital and fixed assets that are necessary to operate the business and generate those profits upon which the valuation is based. To work out the actual value of the company's shares or the equity value means adjusting that debt and cash free value to reflect any surplus assets on the balance sheet or any bank debts. And I'll again talk more about that shortly. So looking at the first side of the valuation equation, underlying profits, the question is, what is the profit measure you should use? Is it profit after tax, profit before tax? The profit figure that we most often use is operating profit. So this is the earnings before interest and tax of a company, or if it's a company that has amortize intangible assets on its balance sheet and amortizes those assets, it would be appropriate to use EBITA, earnings before interest, tax and amortization. Sometimes it's appropriate to use EBITDA, which adds back depreciation as the basis for the profits. It is often used. For businesses, service businesses, that would be appropriate. The problem area is businesses that have a high level of capital expenditure and continually need to invest in new plant and equipment or their fleet of vehicles. And for those sorts of businesses, using EBITDA can give an inflated valuation because some of the profits is actually being used to reinvest in fixed assets, and therefore it's not real profits that ought to be allowed for in the valuation. We don't. It's important to adjust the reported profits to take into account of any exceptional income or expenses shown in the company's accounts. So this could be a sort of a one-off sort of item within the P&L that would skew the results, and therefore it's important to strip those out and just work out what the underlying profit of a business is. A very common sort of adjustment that's required is the cost of management. So for privately owned businesses, owner managed businesses, it's very common for tax planning reasons for the owners to take a very small salary and then declare dividends in lieu of a proper salary. When it comes to working out the underlying profit of a business for valuation purposes, it would be appropriate to add back the actual management costs, which might be a small salary, and replace that with a fair value salary, which would normally be quite a bit higher. It's also there's also a question of which sort of period do you use when trying to sort of work out a company's valuation. Do you just look at the most recent year's accounts, or look back over several years and take an average? The answer is, yeah, it depends on the circumstances of the business and what's sort of more approximate to what the future profits of the business are likely to be. If it's a business that has lumpy performance year on year, it might be appropriate to take an average over the last 5 years or last 3 years to use as the sustainable profit figure. If it's a business that's growing quickly, it might be appropriate just to use the last quarter's performance and then annualize that in order to work out what the underlying level of profits are. So that's the profit side of the equation. You've then got to multiply that profit figure by a number to arrive at the cash and debt-free value. So this is quite a subjective sort of area. There's no sort of right or wrong answer really when it comes to what earnings multiple needs to be applied. It ultimately comes down to professional judgment, and the kind of factors that lead into what earnings multiple should be used all basically sort of look at what the risk factors exist in the business and what opportunities there are for growth. So the kind of things that we'll look at would be, does the business have recurring revenues, or is it starting from a clean slate each year when it's looking for sales? Businesses that do have a high proportion of recurring revenues will be seen as less risky and have a higher earnings multiple compared to businesses that don't. Does the business have barriers to entry? Does it have a strong market position? If it does, again, that would lead to a higher earnings multiple. The spread of customers is a common issue. If it's a business that's reliant on one or two key accounts, that would be perceived as a very high risk for buyers and would detract from the earnings multiple. And the strength of the management team is another important one. If it's an owner-managed business where there's a degree of reliance on the shareholders for the business's management and success, that would detract from the earnings multiple. As a general rule, larger businesses will tend to have higher earnings multiples compared to smaller businesses, and that's because, generally speaking, larger businesses will have less reliance on their owners, a sort of a broader management team. Generally speaking, will have a stronger market position, perhaps more barriers to entry, and will be seen as less risky, and therefore have a higher earnings multiple compared to smaller businesses. There aren't really any sort of reliable lookup tables that you can use. I think some organisations do publish data concerning earnings multiples in different sectors, which are generally derived from much larger sort of transactions where the deal values have been disclosed. So those that sort of publicly available data, the earnings multiples are quite high compared to SME businesses, which in our experience the earnings multiples tend to be in the range of sort of 3 to 5. Typically they can be higher, they can be lower, but that's the sort of range that SME businesses tend to sit in. So as I've mentioned, once you've worked out your enterprise value or debt and cash free value, it's the actual value of the shares will be slightly different depending on how much debt is on the company's balance sheet, and if there are any surplus assets on the balance sheet. And by surplus assets, what I mean is cash that's held on the company's balance sheet in excess of the company's monthly requirements, and commonly freehold property. So if a business has owns its own premises or has freehold property, then it's that would be added on to the company's equity value. If it's a business that doesn't pay any rent, then again, going back to the underlying profitability part of the equation, it would be necessary to deduct a notional rental value to ensure that the business is valued as if it was renting premises. And then when we come to the equity valuation, we will add on the market value of the company's premises at that stage. It's important to note that when we say the company's cash will be added to the equity value, it's not every single pound that's in the company's bank accounts. It's just the surplus cash over and above what the business needs to operate day to day with. Usually it's necessary to work out what the company's average working capital requirements are, perhaps looking back over a 12-month period, and then there'll be an adjustment to the valuation to work out exactly what the surplus cash element is. Any debts on the company balance sheets would be deducted from the equity value. So any loans owing to the bank, CBILS loans, etc. Sometimes there's a question mark over working capital facilities with a bank, whether they should be deducted from the equity valuation or not. Usually they are. That's the starting point. That any bank debt would be deducted, but in certain circumstances, it may be appropriate to treat invoice finance facilities, say, as a working capital item rather than a debt item. And corporation tax would also be treated as a debt for valuation purposes, even though it's not a bank debt. The convention is that corporation tax would be treated as if it was a debt item when it comes to valuing businesses. It's important at this point to note that a business's working capital and fixed assets, plant and equipment, are included in the profits-based valuation rather than added on to the profits-based valuation at this point. And this is to avoid double counting, because the assets that are needed to generate the profits, i.e. the fixed assets, the working capital, they're already sort of factored into that valuations-based, profits-based valuation. If you were to work out a profits-based valuation and then add on the value of net assets afterwards, then that sort of double counts the assets in the business. I mentioned right at the start of this section that sometimes offers may be received from strategic buyers at a premium, and this might be a situation where you've got a large corporate that is pursuing a buy and build strategy, buying up lots of smaller businesses, incorporating them into their group, and looking to generate synergies and cost savings from assembling smaller businesses into their group. So in these sorts of situations, you may find that such a purchaser would offer an amount over and above what you might expect to receive for a company, purely based on its existing profits. But this the danger is that you should never assume that all trade buyers will pay a premium in order to buy a business. In my experience, they will pay a premium if it makes commercial sense for them, and if they need to, if they're in a competitive situation where they need to sort of overpay for a business in order to secure it. It's perfectly possible, but in most situations, the strategic premium is just that. It's a premium that can shouldn't be assumed that you can achieve that. I've noted on this slide that a few reasons why owners of SME businesses often overvalue their businesses, and the main reason is that I've talked about valuing a business based on its sustainable profits. So we're looking at we're just looking at a company based and valuing it based on its profits, but for most business owners, it's more than just a profit stream. It's also their livelihood. It will provide them with a salary for working in the business, and often provide salaries for other shareholders and possibly family members as well. So for that reason, a business is bound to be worth more to its owners than just purely looking at what profits it generates. There's also the potential to make more money by delaying a sale of a business until further into the future. So for that reason, we tend to find that there needs to be a trigger for SME business owners to seek a sale. Most commonly, that's wishing to retire, but it could be ill health, for instance. So that there needs to be a sort of a non-financial reason for wanting to sell a business. If it's just down to making money, then the logical thing to do would be to delay a sale until further into the future, and then benefit from the company's profits in the meantime. Entrepreneurs are inherently confident people. That they almost always expect the future to be bright and profits to increase going forward. But if you contrast that with buyers of businesses, they're going to be very focused on what could go wrong, what risk factors exist in the business, and therefore there's going to be a mismatch between what business owners think a business is worth and what buyers will typically want to be able to be willing to pay. And as I've mentioned on the previous slide, sometimes there tends to be an expectation that buyers will pay a premium. Sometimes they will, but in most cases, that strategic premium is difficult to achieve. So just to wrap up, just a few conclusions. Firstly, we think that it is important that business owners have a clear understanding of what their business is worth, and that will help with their planning for the future, their retirement plans, and also help them make better strategic decisions that will build value over time. Beware of free valuations. They'll either be very simplistic, just looking at a company's P&L and what sector it's in, and trying to sort of compute a valuation based on that, or there could be an ulterior motive if somebody's willing to provide a free valuation. I've talked about valuations more often than not being derived from underlying profitability of the business. So profits are the most important thing when it comes to a company's valuation. That's the starting point. Anything that can be done to increase profits will increase the company's valuation. Don't assume that trade buyers will pay a premium. They are tend to be very commercial people wanting to pay as little as possible for businesses. But by going about a trade sale process in the right way, it maximises the chances of getting that premium. We've got another webinar on selling a business that we'll touch on that. And finally, don't get too preoccupied by valuation alone. It is important, but other sort of things are as important, such as how saleable your business is. Even if the valuation is a good one, if it's difficult to sell that business and realise that value, then that's another thing. If you're looking to buy a business, how a business is funded is probably more important than what the business is valued at and what's going to be paid. I'll hand back over to Andrew at this point, who will just talk us through in a bit more detail about how we can help, and then we'll move on to questions.
Thanks, Greg. Just a very quick one on how we can help. Then, as Greg says, we'll move on to questions. We've had a number of questions asked. Thank you very much. There's still plenty of time to ask questions, but we'll start answering the questions in a couple of minutes' time. So you've still got the opportunity, if you wish to ask a question, please do so. So how we can help at this early stage is give you clarity on how a buyer would look at your business, or how you should look at a business you're thinking about buying, what sort of valuation is appropriate, and giving you accurate clarity is very important, particularly if you're thinking of selling your business. Understanding what the value is going to be, or very likely to be, is important before embarking on the process. So we do valuation reports. They tend to be about 20 pages long. They're set out clearly in non-technical jargon, and there's an explanation as to how we valued it at each step, the different steps. There's a commentary. We give our comments and observations. We show all the calculations. So we clearly set out in a report how we have arrived at the valuation, along with comments and observations. So it gives clarity, even if you're not thinking of selling for 2, 3, 4, 5 years. It gives you clarity as to how the valuation of your business is likely to be approached by potential purchasers. It allows you then to take, when taking key decisions over the next few years, to take key decisions mindful of the impact it's likely to have on your business valuation. I talked earlier about the other services. Our main service is lead deal advisory. Once the valuation is done, once you decide you want to move forward, taking you through the process, whether that's a trade sale, where we prepare an information memorandum setting out details of the business, a document that is the first impression the buyers gets. It's very important that that document is carefully put together and gives the right impression. Doing the buyer research using subscription databases to allow us to identify buyers who ought to be interested in your business worldwide, or whether it's an MBO and advising on what funding options there will be, what sort of deal can be delivered, what sort of valuation, how much will need to be on deferred terms. So our services start with valuations, but move on to lead deal advisory, taking you through the deal. We're going to move on to questions at this stage, and Catherine's going to come on and host this question session. We've got about 15 minutes to answer questions, so there's still time to ask further questions if you wish to do so.
Thanks, Andrew, and thanks for the questions that you've submitted so far. If you want to submit any while we're going through this bit, then please use the Q&A facility and we'll pick those up. Right, the first one is regarding premises. If premises are leased rather than freehold, how would you look at valuing the premises or the lease? I think
any valuation we do has issues we need to look at, and every valuation is different, and we often have to put our thinking caps on when doing valuations to think about the impact of different factors. But going back to what Greg was talking about earlier, we've got almost a bundle of assets and liabilities that are used to generate the profit. And anything that's in that bundle of assets and liabilities generating the profitability is valued using the adjusted profitability times a multiple. And I would say the lease is one of those. If it was a freehold property, Greg talked about how we'd approach that. If it's a freehold property, we would deduct an estimate of the market rent in arriving at the adjusted profitability to apply a multiple to, and then we'd add the value of the freehold property to it. If it's a leasehold property, our question would be, are you paying a market rent? If you think there's a significant value in your lease, is it because you're not paying a market rent? And will that change in the future? What rent will the business need to pay in the future? We need to take account of that. But usually it'd be quite unusual for the lease to have a separate value as part of our valuation, because it's just one of the assets that's used to generate the profitability. Our concern would be, if it has got a value, are you not paying the market rent, and is that likely to change in 2 years' time, for example, at the next rent review? We're also thinking about the length of leases. Often, if a business has been heavily adapted for a trade, and it'd be very difficult for that trade to move to another building without huge costs, then the length of the lease can be quite important. Equally, if we think it's a business that a purchaser will wish to relocate, if it's likely to sell to a purchaser 2 or 3 miles away who would relocate the business, save some property costs, then again, to them, the length of the lease is going to be important. They'll want a short lease. So these things always depend on the circumstances, and this is why there's some subjectivity in there's professional views taken all the way through evaluation and considering different factors, including the one in that question, Catherine.
Okay, thanks, Andrew. The next question, how long does the valuation process take? I think we talked earlier about the report that we put together, but I don't think we touched on timescales.
Shall I take that one, Greg? I'll take this and then you take the next one. The lengthy bit in the valuation process is receiving the information we've asked for. So at the start of the process, we'll put together an information request list and send that to the client and say, this is the information we need. Once we've got that, we can produce the valuation. We won't wait till we've got all the valuation. If you can feed the information through piecemeal, we start working on it and make good progress, so that once we get the last bits of information, we can finish the report fairly quickly. And we'll also do some of the things on the information request list are best handled by a discussion rather than by something submitted in writing. Once we've had the information, we can usually turn the valuation round in 2 or 3 weeks. Depends on the circumstances. I was going to say quicker if it needs to be quicker, but usually it doesn't need to be quicker. People are normally thinking long term about possibly selling their business over the next year, 2 years, 3 years. And they want, a considered opinion rather than a rushed opinion. So we turn it around fairly quickly. As I said, the slowest part is really the client being able to put the information together that we need. But we'll always say to a client, if anything's going to take a long time to put together or it's difficult to put together, pick up the phone, talk to us, and we'll see if we can find a way around using that information. But typically we ask for, 3 years accounts, management accounts. If the monthly management accounts, that's great, for a couple of years plus the current year. We'll ask for analysis of top customers so we can see the dependence of the business on the top customer, the top 2, the top 3 customers. And most of the information should be readily available. But once we've got the information, usually 2 or 3 weeks. If we've had the information piecemeal and been able to make good progress on the report, and we're just waiting for a bit of information, the report might be finished 48 hours after the last bit of information comes in.
Okay, thanks, Andrew. The next question picks up on some of the non-financial aspects of a business. And it's how would factors such as accreditations for quality, staff numbers, qualifications of staff, how would they impact on the valuation?
It's each business will have sort of different factors that are particularly relevant when it comes to the earnings multiple that's used. I think things like sort of having a well-trained team of staff is with clearly defined roles. Is relevant to most businesses. Sorry, what were the other examples?
The quality standards was specifically mentioned by the questioner.
I think, I jump in here because I've seen the question, Greg. You were talking at the time, and I've seen the context of the question. So I think we're talking sort of healthcare sector here. And having contracts for forward contracts, which may be of different lengths. So every business is different, and anything that helps give an indication of future income and security of future income helps. quality marks, the better the quality mark, it reduces the risks in a purchaser's eyes of that business. And if you've got an inadequate quality mark, it increases the risk. So these things, it's about every business we look at has certain key attributes, and it's different from sector to sector. And it's looking at those key attributes to start when we're thinking about security of profitability, what's future profitability likely to be, and the factors leading into our judgment on the multiple. I don't know if you want to add anything onto that, Greg, but I mean, the healthcare sector is a bit different. The multiples tend to be a bit different. The valuations often include the freehold property, which has been heavily adapted for the purpose it's designed for. But we're very happy to anyone asking a question. If you want to talk more specifically about your business, very happy to have a video call with you and just to have a chat and answer your questions.
Yeah, thanks, Andrew. That's all the questions. Oh, hang on, just bear with me. Another one has just been popped up. Just bear with me. Right, it's about let me just read this. For a non-software business, i.e. one valued according to profits of an SME size, so a few million turnover, what are the biggest and smallest multiples that you've used in the last few years? So I think this is asking about the range of multiples that we've seen, excluding software businesses, which I think we mentioned earlier can sometimes attract higher multiples.
It's quite difficult to answer that because we've seen sort of outliers that don't fit in the normal rules. Usually, as Greg said, multiples are probably 3 to 5 to 6. But we do see outliers. If the business is, we don't tend to deal with distressed businesses where you'll get virtually no multiple. Somebody's paying £1 for the business and taking over TUPE responsibilities for the staff and having to sort out the business and know they're going to run at losses for some time. We don't tend to deal with that type of business. So there's certainly multiples of 0 happen. And we've seen really high multiples occasionally, but it's due to specific circumstances, and it is more likely we've seen it on software businesses, but we have seen on other businesses with multiples of 40 for where a very large organization realizes they've got a hole in their service that is affecting their business, and they need to plug that hole with a specialist team to underpin the certainty of their existing revenues now. And it's a petty cash deal for them. They'll pay what they need to pay to get that team on board, because that team is worth 100 times more, 1,000 times more to the business buying than it can ever be worth to the business that is selling. So it depends on the circumstances, but I think outliers for most businesses are best ignored. We will give our honest opinion based on an analysis of your business and understanding your business and chatting to you about its potential and looking at where it's been and what the trend has been.
That's great. Thanks, Andrew. That is all the questions now.
Okay, thank you. We're still willing to answer questions. Catherine will email out the slides. And if you want to ask a question, or even better, we're better just having a quick chat to you, a video call with you, where we can specifically talk about your business on a confidential, no cost, no obligation basis, and answer your questions. We'll welcome the opportunity to talk to any of you about how we can help. Again, it's no cost, no obligation. But thank you for listening. Today's webinar has been recorded and will be put on YouTube later today. So if you've missed part of it, or if you've got a colleague who would like to view the webinar, the link will be available to do so. So I think just a final question saying, please can you leave a contact email? Thank you. Catherine will email you out her contact details with the slides, giving you our contact details. But thank you very much for listening. At this point, I'll bring the webinar to an end. Thank you very much.
Thank you.